Hello, this is Cynthia Fick, and this is the May 16th stock market update. Well, in some earnings news today, Home Depot came out and they missed their earnings estimates. Worst miss they've had in 20 years, and they're kind of leading lower for the next quarter, which is really interesting because they also came out and said that the economy really isn't slowing down. Consumers are still spending with unemployment at 3.4%. People have a lot of equity in their homes. And, there's still some stimulus out there that won't really run out until the end of this year. So they're kind of positive about the healthy economy, and yet they missed their earnings and are leading a little bit lower. So interesting kind of double speak. They also said, I found this really interesting, 40% of most homeowners don't owe anything on their home. They're free and clear, which is amazing also. So this is kind of some double speak, people speaking out of both sides of their mouths that I'm hearing lately. And the first one being of the Federal Reserve. Let's look at this. So last week we talked about how I was encouraging you to keep an open mind about having a less bad result than most of us are expecting. So then another one of the Federal Reserve presidents, John Williams, came out and he said, hold up here. The Fed has not said it's done raising interest rates. He said, I don't see any reason to cut interest rates this year. And generally speaking, supply is still out of balance with the economy. We're expecting credit to be tighter and more expensive. So very different kind of talk than we'd had just the week before. And again, speaking out of both sides. So I, again, am encouraging you to be open-minded about a number of different outcomes that could happen. And that's why we have to be open to anything. Right now, I feel like I'm a backup quarterback in the NFL, trying to watch every play, see what's going on. Not sure what's going to happen when it's my turn to get into the game, but being prepared all the same by watching and looking and seeing what the stock market wants to do. The next thing to look at is, okay, so what's going to happen? And everybody's asking us, questions like this all the time. There's so many different outcomes. Here's 12 outcomes, and there's probably 1,000 more. Number one, the Fed could pause. The Fed could pivot. They could keep on raising interest rates. We could have tame inflation. We could have sticky inflation. Not sure what's going to happen there. That could lead to a soft or hard landing. So these are just 12 of the different scenarios, and that's what we have to keep so open-minded to any situation. We can't become locked into, I know the Federal Reserve is going to pause and we have tame inflation and we're 100% going to have soft landing. We just don't have any way of knowing for sure. Stan Druckenmiller, long-term stock market guru, said that I've been doing this for 45 years. I have made a living with my economic forecast, and this is easily the most challenging period to have a confident forecast I've had in my career. He just said that May 9th. So that's kind of what we're dealing with. So let's look at different scenarios. I just kind of listed out 12 of them. And let's look at what happens historically in the stock market, depending on what the Fed decides to do. And this is within the next 6 months, if after the Fed pauses, if we have an expansion, we don't go into a recession, the S&P 500 is usually up 21.6% over the next year, so a year from now. 10-year treasuries, historically, if this happens, are usually up 8.1%, okay? If the Fed pauses, and within the next 6 months we have a recession, the S&P 500 is usually down 20.7%, and US treasuries are kind of flat. So that is your worst case scenario. Another historical, if the Federal Reserve pivots, and that means within the next 6 months, not only do they stop raising interest rates, but they start to lower them, and there's an expansion, not a recession, that's the best case scenario. The S&P 500 is usually up 33.7% over the next year, and 10-year treasuries are up 19.2. So this is your best case scenario. Of course, if the Fed pivots and we go into recession, the S&P 500 is usually up 7.7 and US treasuries are 11.8. So interesting look at what can happen, and that's what makes this so hard. Again, just watching the market, not getting locked into any one thing. I'm going to again challenge you to keep on, consider that there may be a less bad scenario on the horizon. But again, we just don't know for sure. That's why I'm on the sidelines watching the market and the game and deciding what's going to happen, because we have been in basically a trading range since the October low in the S&P 500. We made a pretty big comeback. We started off in 23.3, broke through that major trend, downtrend line that we'd had going on. And then the Silicon Valley Bank issue happened, and we went down and retested a lot of these moving averages. We've come racing back up, and we've been basically trading sideways for about 4 or 5 weeks. And we will break out of this one way or another. We're coming up to that old high. We'll either break through it and the upside, and that's going to, cause me to take action on one level, or we will break down and go back and retest some of these moving averages. And again, that could cause us to make a decision. So either way, I'm on the sidelines trying to figure out what the next play in the game is. And as always, I will keep you up to date. If anything changes, I will let you know that too. So I look forward to speaking with you next Tuesday. Have a great week, and I'll talk to you then. Bye-bye.